Hello, Facebook. Welcome to the 39.6 live Facebook show, episode number 10, where we discuss today all about preferred rates of return, in particular in real estate syndications.
Let's listen to your music. Start the tunes and I'll start to groove. I'm listening. Hey, let's get moving. I love dancing, dancing, dancing. Come on and sit around with me. I love dancing, dancing, dancing. I love dancing. Dance now, clap.
All right, so we are coming back to you live from Texas. We are back home from our Airbnb trip through Canada. Yesterday, I broadcast episode number 9 from Quebec Airport, and we talked about limited partnerships and the difference between a general partner and a limited partner. And I wish I had my school bus here, but we basically explained a straight equity split. And whenever I'm done with a podcast, sometimes I realize I made a mistake, and I should explain that mistake in the next episode. So at the very end of the podcast yesterday of the show, I had mentioned if they sold their business for $300,000, and they initially invested $9,000 total, that would be a gain of $291,000 to be distributed amongst all 10 of the shareholders. So that's 29,000 people, or $29,000 per shareholder, and each shareholder invested only $1,000. So they would get an astronomical return of 29 times their money back, okay, on that example. So saying hi to people joining us. Thank you for coming, Audrey and Kate. Welcome to the show. Okay, so today we're going to be talking about preferred rates of return, okay? And just to do a brief aside, we're going to discuss the difference between a stock and a bond, okay? Now, if you loan money to somebody and they pay you that money back, but with interest, you are basically investing in a bond, okay? Because you're getting a set amount of money back to you every month or every year, depending on how that loan is set up. You know exactly that what your return is going to be, assuming that the person who owes you the money actually pays, okay? That is a debt investment, and that's what you're investing in when you invest in bonds. They are felt to be safer because a company always has to pay down their debts before they can give any profits to the people who own the company, okay? Now, the people who own the company, like the 10 people in the bus yesterday, they basically all own what we call equity, or they own shares of the company. Okay, and in that example, we had 10 shares. So they each got 1/10 of the profits whenever the profits were distributed. Okay, but if there's no profit, then they earn no money. So when you invest in a stock, you own a portion of that company and you are entitled to a portion of those profits. But if there's no profits, there's no money coming to you. If you had loaned money to the company, well, they have to pay you first before they give the shareholders any money. So you are more likely to get paid. You are more secure in your investment, but you also don't have the opportunity to have as much return on your money. So in yesterday's example, they earned 29 times their money in 1 year. That's an astronomical return. But if you had just lent money, you would not receive money at that interest rate. Nobody would ever give you interest at a rate that high, okay? So when you invest in loans, they're slightly safer, but your amount of return is capped. So what we say is it's safe, but it has limited upside potential. You can only earn so much, okay? For example, on a credit card, that has probably the highest upside potential in general. Sometimes people are paying like 24% interest on a credit card. They pay very high interest rates. Credit card companies make tons and tons and tons of money. okay? Because a lot of Americans can't pay off their credit card debt. But 24% interest is very high. But that money on the credit card is what we call not secured. It's unsecured. They can't basically repossess anything from you to foreclose and get money back. You're getting that money basically for free, okay? Now, on the opposite side of the spectrum, okay, when you have equity, you're less secure because you only get paid if there are profits. However, if the company makes a lot of money, you have an unlimited ceiling. A company can be worth billions of dollars, okay? And it could have started out as being a company worth like $1,000. So the amount of growth it can have can be like 1,000,000-fold over a number of years. Okay, so that's an incredible return. So the upside potential is very high when you own equity, but the downside potential, which is basically that you never get any of your money back, can be significant as well. Okay, so it has more risk, but also potentially more reward. Today, when we talk about preferred rates of return, it's basically something between a bond and a stock. It has downside protection the way a bond does, but also has upside potential the way an equity does. Has a little bit less downside potential, downside risk, but a little bit less upside potential. Okay, but it still gives you a lot of potential for growth. Okay, it also gets taxed like an equity. So if you're a high income and this is in money that's outside of a retirement account, that's really valuable. You don't want to have money tied up in debt that's taxed very highly. So I lost my title here, preferred rates of return. Okay, so I'm going to show that there. Okay, so in a real estate deal, there will be, okay, here is the sponsor, okay, the guy driving the truck. This sponsor found the deal and has got investors. Okay, we're going to use these cubes as the investors. Okay, you can't see all the cubes here, but here are all the investors who are investing in the deal. Okay. Ooh, that's too high. Okay, so here we go. We have investors and we have the sponsor. Okay, now these two people in yesterday's example, okay, they all had equal shares. Okay, so we had 9 passive investors and we had 1 sponsor, and they divided everything 10%. Okay, when you do a preferred rate of return, the sponsor does not get paid until the passive investors over here get their preferred rate of return first. Okay, so for example, let's pretend everybody here who is a passive investor invested, let's say they invested $1,000. Okay, and that $1,000, I'm going to put it a little bit higher here so you can see them better. Okay, so they each invest $1,000. Now they invest in a deal that has a preferred rate of return of 6%. Okay, and 6% of $1,000 would be $60 per year. Okay. Hello, Ari. Welcome to the show. And every time I say hello, I lose my my screen here. Okay. Preferred rate of return. Okay. So we're talking about preferred rate of returns. So if we say that everybody who invests $1,000 as a passive investor gets a 6% preferred rate of return, they have to get $60 each first before the sponsor over here gets any money. Okay, so basically, let's pretend they all invest. Here in this example, we have 8 passive investors. They each invested $1,000, so there's $8,000 invested. And in the first year, they only generate, let's say, $400 of profit. Okay, or $400 of revenue after paying their expenses. So basically, profit. So that $400 on these $8,000 of investment money is only 5%, okay? But the preferred rate of return was 6%. So that entire $400 has to get divided evenly amongst the 8 investors. So they each get $50. They got a 5% return. The sponsor over here gets paid 0. In yesterday's example, there were 10 investors, the 1 sponsor, and the 9 passive investors, and they would have each gotten $40 evenly divided amongst all of them. Okay, the sponsor would have gotten paid even though it only generated 5%. Okay, with the preferred rate of return model, they get all the money. The passive investors get all of the money first. Okay, only until the preferred rate of return is met. Okay, so let's pretend instead of earning $400 the first year, it earned $480. Okay, so $480 would be 6% exactly. Okay, so the preferred rate of return was 6%. Each of them is going to get $80. Okay, or sorry, $60. $60 each times 8 people is $480. They got their preferred rate of return. The sponsor over here still gets nothing. Okay, now let's say the following year, the investment has made more money, okay? And so now it's making, let's say, $500 instead of the $480. Not much of a difference, okay? But the first $480, all of that goes to the passive investors to get their 6% each, $60 times 8 people, okay? They get their preferred rate of return first. There's a leftover $20. Now, after the preferred rate of return is met, that $20 will get divided based on the equity proportion that is decided upon in the investment offering. Okay, so for example, it could be decided that the sponsor over here gets 20% of every additional dollar, and the passive investors get 80% of the remaining money. Okay, so what ends up happening is there is $20 left over. Okay, so the sponsor would get $4, okay, or 20% of that, and then the passive investors would get $16 or 80% of it. So they get $2 each, okay? And if I want to make this a little bit simpler, I'm just going to take Pinky over here, okay? And Pinky and the horse are going to be co-sponsors on the deal, okay? So we are going to end up with a total of 10 investors in this deal, 2 of whom are sponsors and 8 of them are passive investors. So that $20 is going to get divided so that each of the passive investors gets $2 and each of the 2 sponsors gets $2. So basically gets divided evenly, 20% to the sponsors, 80% to the passive investors, okay? Now, the following year, let's say it makes $600, okay? These passive investors have to get the first $480 because remember, they need to get their PREF, their 6% preferred rate of return, or their PREF, which is $480. They need to get that first. There's still another $120 remaining of profits to distribute. Okay, so now the sponsors are going to get paid from that $120. So 20% of it is going to go to the sponsors, and then 80% of it is going to go to the investors. So of that $120, each of the passive investors is going to get $12, and then the sponsors each are going to get $12. We're just going to divide that $120 amongst all 10 of the shareholders. Okay, and so we do the preferred first, and then everything is split even Steven, 20-80. Okay, The next year, let's say the property makes $800. Okay, so $800 means, again, the preferred $480, 6% has to go to all of the investors. Okay, and I think I said $800. So we're going to have 480 go here. That leaves you with 320 left. And that gets divided $320 amongst all 10 shareholders, $32 each. Okay, so basically the sponsors get $32, and then the passive investors get $32 plus that $60 preferred. So they're getting $92, 32, 32. Each of the passives get 92, and then the sponsors get 32. Okay, so basically the preferred rate of return always comes first on that cash flow. Okay, now different deals will have some different structures on what happens if, let's pretend in a given distribution, a given year, it goes underneath the preferred. So on the very first example, it only made $400 in that first year. So they would each get $50 to the passive investors, and the sponsors would get nothing. Okay, but they did not even get their PREF. They did not get the $60 each they're supposed to get. So the following year, if they made extra money, if they made $70, okay, per shareholder, if they made $560, they each get $70 first before the sponsors get a penny. Okay, that would be doing what's called a cumulative model, where you have to get where the preferred is a cumulative percentage over the holding period of the entire investment. And if you ever go under, you have to catch it up first on the following distribution before the sponsors get paid. Okay, and different deals can have different details about how this works. Okay, but in simplicity, assuming the property or the investment earns enough to meet that PREF, the PREF will always get distributed, and only the money above and beyond the PREF will go to the sponsors and the other investors. Okay. Now, often, if there is a preferred rate of return, okay, the preferred rate of return is great for the investor because it preserves their principal. They get paid first before any of the extra profits go to the sponsors. Okay. And so that's really good to help protect their money. Now, because the sponsors over here are running the deal and giving up some of their security by giving the preferred to the passive investor, they have to get a bonus if they do very well, okay? And this bonus is often referred to as what's called a waterfall or a hurdle. It really just depends how it is. So let's pretend the deal is such that if the cash flow exceeds 12%, okay, or let's say 10% to make it easier, it'll have a 6% PREF or preferred rate of return, but at 10%, it will then get split to a different proportion, okay? We said 6% PREF goes to the passives. Then after that, we said it went 20%, 80%, so that it would all be even. But after we say we get to the hurdle of 10%, then it might get split, let's say 50-50, okay? And that 10% is based on what the total return of the investment will be, okay? And again, a lot of these details will be different based on deal, but let's pretend the investors put in $8,000, okay? So that means there's $8,000 invested. Now, let's pretend in a given month, it makes 15%, or a particular year makes 15%. Okay, so 15% of $8,000 is $1,200. Okay, now remember the first 480, okay, is going to go directly over here to the passive investors. Okay, but we started with 1,200. Okay, so now there is an extra $720. Now, we don't have it go all 720 even Steven across the board, $72 per investor and $72 per sponsor above and beyond the PREF. Because once we hit the $800 mark, that already is a 10% return on the total deal. Okay, so basically between 480 to 800, it could go, that $320 could get distributed evenly amongst all of the passive investors, okay, and then $32 to the sponsors. But once we get past 800, that extra $400, which is past the hurdle, that $400 gets spread disproportionately, okay, where it goes $200 to the sponsors. So it goes $100 to each person, and then $200 to all of the passive investors. So they each get $25, and then the sponsors each get $100. Okay, so after the property starts exceeding very high numbers, the sponsors get a higher percentage of the payout. So they have more potential to make a lot of money if the property does very well. Okay, so they have a lot of upside potential. But if the property does not do very well, they could make nothing. On the other hand, the passive investors who have a preferred rate of return, they're able to safely get 6%, okay? But getting beyond like the hurdle, then they're gonna have less returns. But at that point, they're getting more return than they were expecting to get anyway, okay? So that hurdle, which could be, for example, 10%, that could be based on 10% of the entire deal, or it could be after the passive investors reach their 10%, then it goes 50-50, okay? Now, some other deals are even more complicated, where let's say the first 6% of returns all goes to the passive. Then the next, let's say 4% up until 10 goes 80-20. Then the next 3% after that goes 70-30, 70% investor, 30% sponsor. Then the next 3% goes 60% investor, 40% sponsor. And then everything beyond that goes 50-50. So that would be what's often more referred to as a waterfall, where every level of higher return, the investors get less and less and less of their returns, but the sponsors get more and more and more of the returns. Okay. And so basically different deals have different situations. The offerings are made because the people who are sponsoring the deal need to feel compensated for the work they put in, and the investors who put money in feel like they need to basically be able to get returns that meet what they want based on the risk that they're taking. Okay, and so it's often set up. Any deal can be different based on what the price was for the property, what the returns are expected to be for the property. But the sponsors and the investors both have to be satisfied with the returns they're getting and the risk they're taking on. And ultimately, the seller has to be selling the property for a price that they feel compensated on. So these deals are set up so that it's really a win-win-win structure. Because if everybody doesn't get what they want, then the deals don't really go forward. Okay. But in deals like this, everybody can get what they want. The people who are passive investors want to get a good return and don't want to deal with all of the work of running this kind of a business or running a property. Okay. And the sponsors over here, well, this is their job. They want to manage these assets, find the assets, make these deals happen, and they get compensated for that as doing their work. So basically, they get good returns, the investors get good returns, and everybody can be happy. Okay. And for me, I love deals where we have preferred rates of return because I like to invest as much money as I possibly can at all times. And I don't have to worry about things like the market as much if I have a preferred rate of return, because this preferred rate of return gives me some stability like bonds do, but having some equity portion also gives me the upside. And this is a great way to both preserve principal, but also grow wealth at the same time. All right. So that's it for tonight. Episode number 10. So for those who haven't been here before, please check out my blog at 39.6.com. I am trying to get all of my videos shared there so you can go back and see any other videos you'd like to. Subscribe. You'll get on the newsletter once we start sending those out. And please share this so that other people who might be interested, learning more about investing, learning more about real estate, and basically what our goal is to help people find ways to have their money work for you so you don't have to work for your money. Until next time, episode number 11 tomorrow.
Hey, let's get moving.
Peace out. Hello, Jen.
Come on, and spin
Hello, Ari.